Welcome to This Explainer. Today, we're taking Vietnamese Accounting Standard 03, VAS 03, and actually bringing it to life. We're not just going to sit here and read dry accounting rules. We're going to follow the complete, chronological life story of a business asset, from the moment it's just a glint in a CEO's eye to its final days of retirement. We'll see exactly how these regulations govern its entire existence. But before we get completely bogged down in the heavy jargon, we got to ask a pretty fundamental question. What exactly makes an asset fixed? And why does standardizing something like a factory machine or a delivery truck matter so much to a business's bottom line? Well, these tangible fixed assets usually make up the absolute lion's share of a company's total worth. How you classify them directly impacts the profit or loss reported for the entire year. It's not just paperwork, it is the financial reality of the business. To make sense of all this, we're going to map out the asset's life cycle across 5 key stages: concepts and standards, determining initial value, subsequent costs, asset depreciation, and finally, disposal and reporting. Let's get right into it. Section 1. Concepts and Standards. So, to officially birth an asset onto your balance sheet, paragraph 06 lays out 4 strict hurdles you have to clear, all at the same time. First up, it's got to bring certain future economic benefits. Second, you need a reliable measurement of its cost. Third, you have to expect to use this thing for more than 1 year. And fourth, it has to meet the current value standards set by regulations. If you miss even one of these, bam, it's just a regular operating expense. Now, interestingly enough, this foundational standard was actually issued by the Minister of Finance all the way back on December 31st, 2001. So yeah, it set the historical ground rules for how Vietnamese businesses must track their major investments, establishing a real bedrock of transparency that people still heavily rely on decades later. Okay, moving on. The absolutely most crucial concept you need to grasp right out of the gate is initial cost. This encompasses literally every single cost required to get that asset assembled, installed, and totally ready for action. We're not just talking about the sticker price here. It includes shipping, site prep, installation, testing. Basically, if you had to pay for it just to get the machine to turn on and do its job, it is legally part of that initial cost. Which leads us perfectly to Section 2, determining initial value. So, the calculation rules actually shift depending on exactly how you got your hands on the asset. If it's a purchased asset, you take the purchase price, subtract any discounts, add non-refundable taxes, and then add in all those direct prep costs we just talked about. But if it's a self-constructed asset, the initial cost is simply your actual practical cost to build and install the thing from scratch. And the standard makes one thing incredibly clear here. You absolutely cannot include internal profits if you built it yourself.
But hold on, you can't just throw every single receipt into the asset's value. Paragraph 17 explicitly warns us about what gets excluded. Things like general administrative overhead, general production costs, or, say, early operating losses, like if a brand new machine malfunctions during its first week on the job, those cannot be crammed into the initial value. Those are simply the costs of doing business for that period, not part of the physical asset itself.
All right, Section 3, subsequent costs. Now, once our asset is out there working hard, eventually it's going to need some TLC. And when you spend money on an existing asset, you face this massive accounting dilemma that every business owner wrestles with. Is this just a routine repair, or is it a full-blown upgrade? And trust me, this isn't just semantics. How you answer this literally dictates how the money is recorded, and ultimately, how it hits your taxes and profits. Here is the crucial takeaway based on paragraphs 23 through 25. If you're just doing standard maintenance, restoring or maintaining the machine's day 1 capacity, that money goes straight into your operating expenses for the current period. But if you are genuinely upgrading it, meaning you're extending its useful life, increasing its output capacity, or significantly boosting the quality of the product it makes, those costs are capitalized. They are actually tacked on to the asset's overall initial value on the books. You are, from a legal standpoint, making the asset financially bigger.
Next up, Section 4, Asset Depreciation. Look, over time, our asset is inevitably going to lose its value, whether that's from physical wear and tear, technological obsolescence, or even legal limits on a lease. But you don't just guess how much value vanishes into thin air. There are strict frameworks for this. Paragraph 32 outlines 3 distinct methods you can use to systematically distribute the asset's depreciable value over its active life. You've got the straight line method, where the expense is exactly the same every single year, the declining balance method, which front-loads the expense for assets that drop in value quickly, and the units of production method, which ties the expense directly to how many items the machine actually spits out. The catch? You have to apply your chosen method consistently unless the fundamental way you use the asset actually changes. But how do you actually know how long to depreciate it for? Well, choosing the right method depends entirely on accurately estimating this concept called useful life. Basically, the time period, or total number of units, you expect to squeeze out of the asset. And here's the thing, it is not a set it and forget it number. Paragraphs 33 and 34 mandate that this figure has to be reviewed periodically, usually at the end of the financial year, based on actual real-world usage, physical wear, and even technological shifts in the broader market.
Finally, Section 5, Disposal and Reporting. When an asset is finally disposed of, it is rarely a perfectly clean break financially. Any resulting financial gain or loss has to be meticulously calculated. You take the income you got from selling or scrapping it, and you subtract the cost of getting rid of it, plus whatever value was still left sitting on the books. That final number, whether it's a gain or a loss, absolutely must be reported directly on the income statement for that specific period. But of course, the story doesn't truly end until the paperwork is filed. Paragraph 39 lists some pretty extensive reporting requirements. All these granular details, from your calculation methods and depreciation rates to your beginning and ending balances, which assets are currently pledged as collateral for loans, and even the original cost of assets that are fully depreciated but somehow still stubbornly chugging along on the factory floor. Every single bit of it must be fully disclosed in the financial statements. This whole standard went into effect on January 1st, 2002. And since then, these strict reporting requirements have ensured some really vital transparency and consistency across the entire Vietnamese business landscape. It ensures that when investors or regulators look at a company's assets, they are seeing a standardized reality, not just some creative accounting magic. But that brings us to a fascinating, almost philosophical conclusion for this explainer. Paragraph 40 explicitly admits that estimating an asset's useful life and its depreciation is, at the end of the day, entirely a matter of human judgment. It's an educated guess. Which leaves us with a pretty provocative question to end on. If the massive numbers sitting on a company's balance sheet under fixed assets are heavily reliant on human estimates of the future, just how objective can a finalized balance sheet truly be? Next time you look at a company's financial health, try to remember the human element hiding right behind the math. Thanks for joining me on this explainer, and I'll catch you next time.